Bank of England hiked interest rates by 25 basis points today, taking the base rate to 4.5%. But not just that, they also raised their forecast for inflation and growth over the next few years, which could make the challenge of getting inflation back to its 2% target that much more difficult. Inflation is now expected to fall to 5.12% by the fourth quarter of this year. That's quite a lot higher than previously forecast at 3.92%, while in 1 year's time is expected at 3.38%, above 3.01% in February, and in 2 years at 1.1%, slightly above the February forecast of 0.95%. So quite a sharp upgrade to inflation forecast, particularly this year, with food price inflation being a key part of that. And then on GDP, it's also higher. Now, this may come as a comfort to many, the idea that we could avoid a recession this year, which is what the Bank of England previously forecast, and quite a long but shallow recession at that. But that is going to make the Bank of England's job that much more difficult, because avoiding a recession and better unemployment means that we're going to see more demand. So in terms of GDP, the Bank of England now expects growth this year of 0.25%. That's up from the February forecast of minus 0.5 in 2024. Similarly, 0.75% growth versus previous forecasts of minus 0.25. Then in 2025, again, plus 0.75%, above previous forecasts of 0.25%. So that's quite a considerable upgrade to growth over the course of the next few years. So this should make life very interesting for the Bank of England. That's why we're expecting now interest rates to rise once or twice more this year. You can see the market implied pricing here shows that there's a very strong chance of 2 more rate hikes this year from the Bank of England. And not just that, then we start to see the rate cuts coming maybe early towards the middle of next year. Of course, this is all subject to change. A lot has changed in the last 3 months, which has caused such a shift in these forecasts from the Bank of England. And if you think of what's changed more recently, which could affect the forecast in 3 months' time, the banking situation in the US, we've seen a number of collapses at this point, which has caused tighter credit conditions, but that's been most notably seen so far in the US, but that could have ripple effects elsewhere. There's also a lot of economic data to come over the course of this summer, which will have significant implications for forecast then in August. And the reason I say that is because we're now still around the peak of inflation, and it's at this point that we and the Bank of England were all expecting the rate of inflation to fall sharply, coming around the anniversary, of course, of the war in Ukraine. And if that does not materialize to the same extent that the Bank of England is forecasting, or even to a much greater extent, that could have a significant impact on what we can expect, therefore, from the forecasts in August. As always, these forecasts are not here to necessarily guide expectations. It's more just what the Bank of England uses when determining its interest rate decision making. Other people produce different forecasts alongside those, but these are simply just a guide as far as households and businesses are concerned, and they are subject and have been subject to significant change for quite some time now. As far as the US is concerned, we've had some PPI data today that came on the back of CPI data yesterday as well. And it was relatively good news. We saw slightly softer PPI figures today, so that's promising as far as future inflation is concerned, particularly on the core side. And then yesterday, the CPI data was slightly softer than expected by around 0.1% on the headline figure, and roughly in line as far as core is concerned. But that did generate some optimism. There was fear going into those releases that we could see a bit of overshoot, which could really complicate matters for the Fed and maybe even force them to raise interest rates one more time, or prolong the period of peak interest rates into later on in the year. So that's been taken as a slight positive in the markets, and we've got a lot more data to come now before the next Fed meeting in a month's time, when we should see much better economic data on that front, and which could encourage the Fed to pause its tightening cycle for now. And with that, let's take a look at a chart. Now, of course, we've got the pound dollar chart in front of you here. And I think the most notable thing that we can see from the pound dollar chart right now is the fact that we haven't seen any significant breakouts more recently. We're still seeing the pound dollar running into a lot of resistance around that 126.50 mark, where we've run into a lot of resistance actually just over the last few days. It's interesting that we've seen a decline over the course of today, because we've seen that slightly softer PPI data, which could have been viewed as being a negative for the US dollar. But at the same time, we've seen a more hawkish Bank of England, which could have been viewed as a positive for the pound. But instead, we've seen this pair actually decline off those highs, potentially a sign of trend exhaustion here. And that really is backed up by those momentum indicators at the bottom. You can see the stochastic has been steadying off recently, and actually over the longer term been making a series of lower highs. So that's seen as being divergent with price action and could potentially be viewed as a bearish signal around such interesting levels that we're seeing now, that 126.50 and of course 127.64, the 61.8 fib as well. And you're also seeing that in the MACD. Again, not quite so clear recently, but the MACD histogram has basically flatlined coming off those highs that we were seeing back in March and April time. And you can see the MACD moving averages as well have generally been trending lower as prices have been moving higher. Again, a sign of trend exhaustion around some key technical levels. I think what's interesting mostly here, though, is the fact that the narrative has firmly changed and is starting to be backed up by some of the data. One thing that could complicate this now over the next few months would be that sharp decline in inflation from the UK, which could back the Bank of England's desire to pause its tightening cycle at one of the upcoming meetings. The next meeting may come a little bit too soon, but clearly with two policymakers already backing a pause and having backed a pause now for 2 or 3 meetings, it's quite clear that we could see a bit more debate on the MPC, which could effectively encourage the central bank to pause its tightening cycle over the next couple of months, as long as the data does allow for that. The economic data, as I've said repeatedly here, is going to be absolutely crucial over the course of the next couple of months if we are going to see signs that we are going to see inflation return to target at some point over the forecast horizon.